let's look at a note that has an improper or unrealistic interest rate assigned to it. And we're going to look at Amber Milling or Mining and Milling here. Amber Mining and Milling Incorporated contracted with Truex Company to have constructed a custom-made lathe. The machine was completed and ready for use on January 1st, 2013. Amber paid for the lathe by issuing a $600,000 three-year note that specified 4% interest payable annually on December 31st of each year. So we signed the $600,000 note, and each year we're going to pay interest at 4%. The cash market price of the lathe was unknown. It was determined by comparison with similar transactions that 12% was a reasonable rate of interest. So since 12% is a reasonable rate, the fact that we've only got a 4% implied rate on this note is not a realistic interest rate. So what that tells us as individuals or as accountants, we're included in this 600,000 is also some interest. It's not purely the value of the asset. So if that is the case, we have to actually come up and figure out what is the value of the asset. And the way we do that is very similar to calculation of a bond. We have to figure out the present value. So in an unrealistic rate, the first thing we need to find, or the second thing, you can find them in any order, but one, we have to find the PV of the interest that's going to be involved. And the second thing we have to find is the PV of the principal of the note. In doing this, and once we add them together, we can actually break out the interest from the actual note itself, if that makes sense. So what are we going to do? Well, the PV of interest, the first thing we need to find is how much interest is going to be paid. So we're going to take that 600,000, we'll multiply it by 4%, and that's going to show us that 24,000 in interest is paid annually on this note. Now the next thing, you can either use the formulas or we're going to use the charts just because the charts are easier. So we're going to look in here and look at our charts. Now the PV of interest, interest is an annuity because it's paid out over time. It's not a one-time payment. There's multiple payments. And it's an ordinary annuity because the interest is paid at the end of the period, not at the beginning. So in other words, the interest is going to accrue and then we're going to pay the interest. That's an ordinary annuity. So if we look at our tables, there's two things we need to know. We need to know the N and the I. Other words, we know the number of periods and we need to know the interest rate per period. Okay? And sometimes I do not like autocorrect. I do want it to say N. So N equals, and then we're going to do I equals. Now in this case, it is a 3-year term paid annually, so it's a 3 periods there. And then the interest rate per period. Now we have to mark this to the market interest rate. The market interest rate is 12%. So the interest rate we're going to look up is actually 12%. So if you go to your present value tables, and you can print one, the present value table I'm using has rounded to the 5th decimal place, so that's as close as I need to get just in this example. If you want it to be exact, you do have to actually use the PV function in your calculator or use the actual formula. But when we do that, if you look up 3 years or 3 periods on our table and then you go over to 12%, you should get 2.40183. So that's our present value factor. And again, we've already discussed present values, so I'm not going to go into what that means. But if you look at it, you're going to take that present value factor. So if you take 24,000 times that 2.40183, you're going to come up with rounded 57,644. And again, for my class, we just rounded the whole dollar. I'm not going to make you carry those out to pennies. Then the second thing we need to do is the present value of the principal. Now the principal is the 600,000. That is the amount we need to use there. And that is a lump sum because we're only paying the principal back at the end of the term. So when it's a lump sum one-time payment, we call that the present value of $1. So we're going to use the present value of $1 table. And again, you could use the formula if you wanted to figure this out. But again, I'm just going to round it. It's just easier that way for us in this learning setting. So the PV of 1, we're going to again look at 3 periods, and we're going to go over and we're going to look at 12%. And I apologize, I should have had these open so that you could see this, but if you do follow your PV tables that you've got, and most textbooks have them in there, if you're in accounting class, you should be able to find them in intermediate accounting. So when you look at that, you notice that it is 0.71178. And when you multiply it out, we find that the present value of that $600,000 is $427,068. All right. So that is our amount. So what do? We add those two together. So if you take that 427 and you add the 57,644, you come up with a value of 484,712. If I can read my handwriting there. So that is the actual value of the machine. That breaks out any interest that was embedded in that 600. We have to assume that a portion of that 600,000 was going to pay interest on this unrealistic note. All right, so how would we record that on January 1st, 2013? Well, we're going to go in and we're going to record that as a debit to the machinery account. And again, we're going to hit that machinery not for 600,000 because that 600,000 assumes some interest in there, but the 484,712. Now, how much are we actually going to have to pay back at the end of the term? Well, we're going to have to pay back the full 600,000. So that's going to go in as a note payable at the full $600,000 mark. Now, where does the difference go? Well, in this case, we call that a discount on our note payable. So embedded in there is a little bit of discount, and that's 115,288. So that's the first step. Anytime you have an unrealistic note, the first thing you need to do is find the present value so that you can value your asset that you signed that note for. Now, the second thing says prepare an amortization schedule for the 3-year term of the note. So again, our note starts out, and I think I need one more column here. We need 4 lines in total, but we start out at the carry value of the note, which the carry value of a note is the note payable netted with its discount if it exists. Now in this case it's going to be 600,000 netted with the discount. So on day 1 your carry value of your note or outstanding balance of your note is 484,712, the actual present value of the note. Now over time that balance is going to grow because once we've had all of our payments we should be at 600 at the outstanding balance, the amount that we have to pay back on this note. So now the first thing we have to figure out is the cash payment. Well, we really already did that, and we found that it's $24,000 every year. That's the amount of cash that we're going to pay, that 4% in interest. So how did we get that? Well, we took the face value of the note, we multiplied it by the rate, the stated rate on the note, times, of course, time. And in this case, time was 1 because it's 12. It's an annual period, 12 twelfths. Okay? Now, so we got that 600,000 times the 4% times 12 over 12. So 600,000 times 4% gives us 24,000. Now we need to know how to get our interest expense. And our interest expense, again, we're going to take that, the carry value times the effective rate. And that is the 12%, the realistic rate of this note times time. And again, time is 12 out of 12, so 1. So really in this problem, we can ignore time and just take carry value times the effective rate. So what does that mean? Well, for this first one, what you're going to do is you're going to take 484. You're going to take the carry value, 484,712, times the 12%. And when you do that, you're going to get 58,165. Now the amortization is going to be the difference between the two, which is going to be the 34,165. Now, the outstanding balance. Let's talk a little bit about the outstanding balance. The outstanding balance has to eventually increase to the actual carry value, or excuse me, the note payable itself, the 600,000. So from 484 to 600, we're going to add. So you're going to take the outstanding balance, you're going to add the 34,165, and that gives you an updated carry value of 518,877. Now the next year, what are we going to do? Well, again, you take the carry value, but now the carry value is 518. So you're going to take the 518,877. You're going to multiply that by the actual 12% rate. And that's going to give us 62,265. Again, the amortization is the difference between the interest expense and the cash payment. And that comes out at 38,265. And then our carry value again would be the 518 plus the 38, which gives us 557,142. Now again, all of these numbers have been rounded to the whole dollar. In the last year, you're going to take the 557 times 12%. But due to rounding, you are going to be $1 off. So what you get will be a little bit different from me because in the end, our amortization has to be 42,858. Regardless of rounding, because remember we've got to take the 557 plus 42 to get the 600,000. So I want you to multiply that out so you'll see, but it is $1 off, so you do have to adjust your interest expense just a touch so that we do balance simply because we've rounded all the numbers. If we had not rounded, we would have been fine. We rounded, so guess what? When you round, you do have those little bit of rounding issues. Questions about the amortization chart, please let me know. All right, and the last thing says prepare the entry to record the interest for the 3 years and the payment of the noted maturity. Now, I'm going to cheat a little bit, and the reason I'm going to cheat a little bit is because if you can do one interest payment, you can do them all. So I'm just going to do that first interest payment. Remember, it says that interest is paid annually on December 31st. So our first interest payment would be December 31st, 2013. Remember, we signed this note on January 1st. First interest would be December 31st. On that date, we would simply debit our interest expense. And again, once you've done the amortization, you already know, whoops, let me undo that. I don't want that one highlighted. On the wrong row. You already know what your interest expense is because you've already calculated it. We know the interest expense is 58,165. Now, what else? Well, remember, we know that there's cash involved because every year we're going to have to pay out the 24,000. Now, where does the difference go? Well, remember, the discount on note payable gets amortized over the life of the note. So every year, a little bit of that discount is going to get amortized. So we're going to go in and we're going to amortize the discount on notes payable. And again, we already have that number to be 34,165. You simply journalize the amortization chart. Now, what would we do 2014? You do the exact same entry. Okay? And again, I said I was going to cheat just a little bit. I'm simply going to copy this over, paste it into a new cell here, and the only thing you have to fix is our number 62,265 would be my interest expense, and then my amortization would be 38,265. All right, and that would be December 31st, 2014. Now, what would we do December 31st, 2015? Again, if you need to pause to write this down, you can, but I'm going to move on. 2015, that would be our last interest payment, and again, that would be interest expense of 66,858. It would be amortization of 42,8. Oops, I'm on the wrong line. Just notice that 42,858, and again, the cash of 24. Now that brings us to our January 1st, 2015 maturity, or excuse me, 2016. The next business day, we're going to pay off this note. How much do we owe? Well, you could argue that you pay it off on December 31st, 2015. You could also argue the point that would be January 1st, 2016. That I'm not worried about as much. What I am worried about is that we can journalize this. Well, at this point, what does the discount equal? Well, it should equal 0. You started with the 115. At this point, you should have fully amortized all 115,000. The discount should be 0. There's nothing there. But the notes payable account still has that balance of 600,000. So we're simply going to remove that 600,000 from our books, and we are going to pay it off at 600,000. That is an example of an unrealistic note, unrealistic interest rate on a note. What ends up happening is it is a discounted note, and this is how we would actually treat that.